Welcome to StockMarketFunding.com. It is 6:22 a.m. Pacific Standard Time on the West Coast, which means it's 9:22 a.m. in the East. And stocks in Asia were modestly higher at the People's Bank of China. Said that growth was slowing, people. Growth is slowing. That means commodity stock names, related commodity stocks and related bear ETFs would be a good place to be looking there. As it catches up. But they're saying it was healthy and a double dip recession was very unlikely. But you're talking about that in China. That's the one that's been the most, and I don't see a double dip over there. But adding support to the rally was strong earnings from Japanese export Canon. Reports indicate legendary investor George Soros is set to buy a 4% stake in the Bombay Stock Exchange from Dubai Holdings for $40 million. Big deal. Good luck to you. You've been wrong so far, Soros. Valuing the exchange at $1 billion. Looking at the currencies, the yuan closed little change at 6.778, while the yen is stronger at 87.68 in Japan. The Nikkei finished 2.7% boosted by strong earnings report from once again, Canon did a pretty good thing. IT, 4.4%. Financials, plus 4.1% were the biggest gainers as every sector finished the day plus 1.7% or more with the expectation of utilities. In Hong Kong, the Hang Seng closed down up 0.6%, led by IT and consumer staples. Industrials, though, on the other hand, were down. In China, in the Shanghai composite, which was the very first area, as far as I'm concerned, that started the bear move, settled at 2.3%, boosted by PBOC comments saying a double-dip recession is very unlikely. That's in their country. Shouldn't be. Materials, energies, financials, and industrials all closed plus 2.3% or more, as every sector finished higher by at least 1.2%. In India, however, there you settled at negative 0.7% as weakness in energy, minus 2.4%. Industrials weighed on the index. Reliance Industries fell 1.5% after the company announced plans to acquire the polyester plant from Bombay for $64.3 million. So basically, these markets are trying to catch up with their short cover rally. And we'll be watching the one that we're most interested in is this here, China. It's slowing growth. And the thing about it is, in their lending, they have $1.1 trillion of loans out, and we already know that there's probably at least a 23% default. And the old thing of it is, what happens over here can eventually roll over here. So these other worldwide leaders and their markets are trying to catch up to this rally that we have here. Asian markets, that's what it is. Be careful as far as just understanding that the economic data here in the U.S., we should, based on what was happening here with these advances, we should be having a much higher gap, which we don't.